Good
Go.
morning, everyone. This is good group number 22, and today I would like to go through one of the most shocking events in modern history of financial history, the Swiss franc blank Swan event of 2015. This event was triggered by the Swiss National Bank's sudden decision to abandon the euro to CHF currency peg, sent shockwaves around the global markets, exposing critical vulnerabilities in financial markets and risk management practices. To understand the magnitude of this event, let's first look at the context. In 2011, the SNB introduced a peg to stabilize the Swiss franc against the euro, setting a minimum exchange rate of 1.2 euro per CHF. This goal was to protect Swiss exporters and prevent deflation as the strong franc made Swiss goods more expensive abroad. For years, this peg seemed unshakable and market participants grew confident in its permanence. The shocking decision was on 15 January 2015 when the SNB dropped a bombshell. It abandoned the peg without warning. The announcement was abrupt, catching investors, traders, and even the other central banks off guard. The Swiss franc skyrocketed by nearly 30% against the euro within minutes, a move appreciated in forex markets. This decision was driven by mounting pressures including the European Central Bank's stimulus measures, which made maintaining the peg unsustainable for the SNB. The fallout was instantaneous and severe. Foreign exchange turned oil like euro to CHF pair collapsed, triggering a liquidity crisis, and also bid-ask spreads widened dramatically, making trading nearly impossible for some brokers. Major firms like Alpari UK and FXCM faced insolvency, with FXCM requiring a $300 million bailout. Hedge funds and leveraged traders suffered huge losses as their positions were liquidated. This SNB's decision was a classic Black Swan event, rare, unpredictable, and devastating. The dangers of over-reliance on central bank policies, the fragility of highly leveraged trading strategies, and gaps in risk model that failed in account for extreme volatility. Now, Sahar will continue further process.
So I'm going to be doing the risk identification of the case. So the first risk is foreign exchange risk. The sudden appreciation of the Swiss franc created extreme volatility in the FX market. Traders expecting stability had taken on high leverage to maximize profit, but this backfired when the market moved violently. Even risk management tools like stop loss orders failed, leading traders unable to limit their losses. This event proved how dangerous speculative trading can be, especially when relying on central bank interventions. The second one is liquidity risk. As the franc surged, liquidity dried up. Traders struggled to exit positions as demand for CHF skyrocketed. Bid-ask spreads widened significantly, making it even harder to execute trades without major losses. Many brokers had allowed highly leveraged positions, and when traders couldn't cover their losses, brokerages themselves faced financial ruin. This led to bankruptcies like Alperi UK and forced emergency bailouts such as the 300 million lifeline for FXCM. Uh, uh, Now the second one is systematic risk and systematic risk. So the crisis didn't just stay within the market, it had ripple effects um, across global financial markets. Um, stock markets dropped commodity Stock markets dropped, commodity prices fluctuated, and financial institutions suffered heavy losses. The event highlighted the fragility of financial markets and the risks of over reliance on central bank policies. Um, uh, in response, regulators tightened margin requirements, imposed stricter capital controls, and introduced tougher risk management. Um, the key takeaways and lessons learned from this is that the Swiss Franc Black Swan event was a wake up call. It reinforced the importance of proper risk management, especially when it comes to hedging strategies and controlling leverage. It also showed the need for better liquidity and counterparty risk planning. Most importantly, it proved that financial markets cannot depend too heavily on central banks for stability. Moving forward, institutions must prepare for extreme scenarios to avoid another crisis of this scale. Now, Muhammad's going to take over and he's going to um, explain the
Yeah.
quantitative
Good
analysis.
morning. Yeah. Good morning. I'm Ahmad Abdul Khader. So today I'm going to discuss about the quantitative analysis. First, I would like to talk about liquidity analysis. Liquidity basically means how easy you can buy or sell something without affecting its price too much. In normal conditions, the forex market is highly liquid, but that completely changed when the Swiss National Bank made its surprise announcement. Right after they removing the currency pledge, the market went into shock. The bid-ask price spread, which is a key measure of liquidity, suddenly widened a lot, sometimes over 0.30. This means traders couldn't buy or sell as easy, and transaction costs shoot up. Because of this, many investors were trapped in bad positions and leading to panic selling and massive losses. Some brokers went into bankrupt because they couldn't handle the sudden price movements and liquidity crash. On Now let's talk about the credit spread. This means the difference between interest rate on government bonds and riskier corporate bonds. When credit spreads widen, it basically means investors see more risk in market. After the Swiss National Bank decision, credit spread jumped, investors panicked and moved their money into safe assets like Swiss national government bonds, pushing the yield down. At the same time, corporate bonds become riskier, so their yield went up. This was a clear sign that market was pricing in more uncertainty and possible defaults, especially for the businesses that were heavily exposed to the currency risk. These hedge funds and institutions lost a lot of money because of the unexpected swings. So, in the simple terms, this event shows us how quickly market conditions can change. Liquidity drains up, making it hard to trade, and credit spread widened, signaling increased risk. It was a wake-up call for traders and institutions to always be prepared for the sudden market shocks. That's from my side. Thank you. And I would like to hand it over to Anmol.
Thank you. Now let's focus on the most crucial part, how to mitigate the risk and prevent financial shocks like Swiss franc crisis from happening again. Why is risk mitigation is critical? The 2015 Swiss franc shock exposed critical weakness in financial risk market management, leading to massive losses for unprepared institution, poor hedging, over reliance on Swiss National Bank, and weak stress testing and risk models are the main problems. The goal of risk mitigation is very simple: reduce exposure to extreme market movement and make financial system more resilient. And the next one is a chart. This chart is showing the dramatic spike in Swiss francs value when the SNB removed its currency peg, catching the market off the guard. The sharp appreciation led to billions in losses, exposing how unprepared financial institutions were. This was a black swan event, rare, unpredictable, and severe, highlighting the need for better risk management. The next is key risk mitigation strategies. To prevent such financial disasters, we need to be strong risk mitigation strategies. The stronger hedging and risk control. And the second one is enhanced stress testing and risk models. The options and stop loss orders can help limit downside risk by automatically adjusting positions when market moves sharply. And then regular stress testing should include major currency fluctuations to ensure firms and resilient to the stocks. Beyond company level strategies, financial regulations must also evolve to prevent such crises. Clear communication from central banks would help financial market to prepare for policy shifts rather than being caught by surprise. Mandatory risk disclosure would ensure that firms provide transparency about their currency exposure, helping investors and regulators assess risk. Then the last one is the implementation and future recommendation. To build stronger financial system, organization must take proactive steps. Developing a risk-aware culture means training financial professionals to anticipate and prepare for extreme market shocks. Leveraging AI and real-time analysis enable the firm to detect market anomalies and adjust risk strategies instantly. Regular scenario planning and policy reviews ensure that firms remain prepared for sudden policy changes and unexpected financial crises. The 2015 Swiss franc crisis was a major lesson in risk management failure, but it also shows how to build a more resilient financial system by implementing smarter hedging, strengthening stress testing, and enforcing better regulation. We can ensure financial institutions are prepared for the next Black Swan event. Thank you. That concluded our presentation.